If your current expenses are around 60,000 rupees a month, at the current rate of inflation, 10 years from now, you would need around 1.44 lakh rupees to buy the same things. That's nearly double the same amount of money. Applying the same logic to your savings, if you're saving 10,000 rupees today, how much would it be worth 10 years down the line? Going by the current inflation rate of 7% or thereabouts, it will fetch you goods and services worth only 5,083 rupees. That means the value of today's 10,000 rupees will decline significantly and your purchasing power will only go down in the times to come. I am not trying to scare you. I am simply decoding what the latest CPI numbers mean for you and I. CPI, or Consumer Price Index, is hovering around 8-year highs of above 7%, and it has consistently been coming above RBI's tolerance band of 2 to 6% for over 6 months now. From your groceries to even your kids' education, everything has become expensive by over 7% in the past 1 year. And this is not all. You might see further price rise in future if the central bank fails to arrest this high inflation rate. Now, you may not be able to control this phenomenon of rising prices, but what you can do is create a diversified portfolio. A portfolio that will help you beat inflation in the long term so that you don't have to worry about what's happening in the short term. In this video, we tell you how to rethink your financial plans and how to budget for inflation. But first, do subscribe to Moneycontrol's YouTube channel and don't forget to like this video. Now, financial planners say it's important to take into account how prices of different items will rise going forward. The general advice is to plan for higher costs of healthcare services and education expenses. But lifestyle expenses also go up as income levels and aspirations go up. And so do groceries and travel expenses. So you must budget for all that. But how do you ensure that your financial goals are met keeping in mind the rising expenses? Here are 3 tips from experts. 1. Try to invest more than you think you can. 2. Be conservative when it comes to projecting returns in your financial plan. And number 3. Start investing in your early years. Now the question is, which are the best investment vehicles amid rising inflation? Real estate. Well, that's a popular choice to invest in times of high inflation. It generates increased rental income. Investors can either buy real estate directly or invest in a specialized fund. Commodities. When inflation picks up, investors often turn to tangible assets that rise in value. Gold has been a safe haven for investors amid high inflation. Investors can look to put their money in ETFs or mutual funds that own gold. Number 3. Inflation index bonds. Inflation index bonds give returns that are more than the rate of inflation. Therefore, the price rise does not erode the value of investors' savings. Stocks are also known to be potential inflation hedges. The market price of value stocks is usually directly proportional to the rate of inflation. Therefore, when inflation rate rises, value stocks tend to perform better. So that's that. You cannot control inflation, but you can definitely control your finances. Start planning now for a better future. For more such updates, subscribe to the Moneycontrol channel and stay tuned to the space for more updates.